On the topic of Fed independence, I want to get your reaction to this Goldman Sachs report on what may happen to certain assets if the Fed does lose their independence. Goldman says gold could near $5,000 if the Fed loses their independence. So if the Fed's independence is damaged and investors shifted just 1% of the privately owned U.S. Treasury markets into gold, then the gold price could conceivably rise to $5,000 an ounce. The underlying assumption here is that a scenario where Fed independence is damaged will likely lead to higher inflation, lower stock and long-dated bond prices, and an erosion of the dollar's reserve currency status. In contrast, gold is a store of value that doesn't rely on institutional trust. This is from a major investment bank. How would you respond to this?
Well, number one, they've gone through some assumptions, and with those assumptions, they've come up with a target price of $5,000 an ounce. Not using those assumptions, but a more standard kind of thinking, and that is what's going on with the growth in U.S. disposable income. I think that this secular bull market in gold that we've been in, David, will maybe end up at $6,000 an ounce, not $5,000. But mine is based on not all these assumptions they've made about Fed independence and what's going on with the bond prices and dollar and all this other stuff. It's a much more straightforward methodology that's worked in the past, and that is to look at what we anticipate the next peak will be in the gold price based on the last gold price peak was back in 2002, over 25 years, well, almost 25 years ago. So if you look at the gold market that we're in now, and it is in a secular bull, and I've been bullish on it almost since day one, I think a peak in this secular bull will probably come in around 6,000.
Can you outline? Yes.
So it's a little higher than the scenario painted by Goldman, but it's based on a completely different methodology. I mean, they have a string of assumptions, and if they plug those assumptions in, they get 5,000.
So just to clarify, are you talking about $6,000 this year, next year, or just sometime during this cycle?
At the end of the cycle.
What would mark the end of this cycle, Professor Hanke? What would
$6,000 an ounce?
Okay, fair enough. Okay. All right, moving on. Are you? What happens? What does $6,000 an ounce mean for the U.S. dollar and inflation?
Well, again, this gets out in the weeds on all kinds of assumptions you have to make and so forth. I think the key thing is we're talking about the gold market, for God's sakes, and where is gold? Is the gold market in a bull market? Yes, it is. Will a bull continue? Yes, it will. Where will it probably end up peaking out at? 6,000. Yeah. Now, what more do you want, for God's sakes? You want to get out and ask me, how's this going to affect the way I tie my shoes and so forth and so on?
Well, I'll tell you why I asked, because a couple of years ago, when I first started covering the gold market, people were saying, well, if $5,000 gold is a reality, that means all sorts of apocalyptic scenarios. That means, world war. That means the dollar's collapse. That means the stock market's collapse. That means inflation's gone out of control, so on and so forth. These are some of the scenarios from a few years ago.
That's leading into the kind of analysis that was behind the Goldman report.
So you don't think that we need major economic shock for gold now to spike up to 6,000? That's not what you're saying.
No, that's not.
Okay.
That's not behind my thinking. My thinking is, look what's happening to the growth in U.S. disposable per capita income, and look what's happened historically to it and how it's related to gold, and go back to the last bull run that ended up peaking out in 2022, and then go forward from that to this bull market. Again, these are back of the envelope kind of calculation, shall we put it that way? But they don't get into all these complexities about what exogenously might happen, what's going to interfere, the independence of the Fed, a world war, this thing, that thing. If those things happen, then gold would go to $5,000 an ounce. That's the way the Goldman thinking is going. My thinking, which by the way ends up at kind of roughly the same ballpark in terms of a price. Mine's a little bit higher. Mine's based on kind of endogenously income growing on a per capita basis. Given that increase, what's going to happen? So again, the question is are we in a bull market? Yes. Will the bull market continue? Yes. Is this the start of a bull market? No, it's kind of middle of the bull market. And then the question is, which I usually don't do, by the way, these kind of target prices. As you know, as somebody is trading, all you have to know is the direction of the market, not what some endpoint is going to be. But my general thinking is I'm comfortable with this thing until it gets up towards $6,000 an ounce.
Fair enough. Now let's talk about the Fed independence itself. Are you concerned, Professor Hanke, that suppose the Fed were to be governed by mainly Trump loyalists, and therefore, strictly speaking, they would have no independence? Then the money supply would grow at faster than 6%, your golden growth rate of 6%, thus leading to higher inflation?
If you change the composition of the personnel and the Board of Governors and the Federal Open Market Committee, and those have, shall we say, a different view than the consensus now, you're going to get a different policy. I mean, it's a simple game. If you change a bunch of people on the Federal Open Market Committee, and they have views that are much different than the current members of the committee, you'll get a monetary policy that's different. And by the way, the idea that the Fed is independent is kind of a joke anyway. It's never really been independent. But at any rate, we're talking about the personalities that are going to be on the governing side of the Fed, and obviously it doesn't take a rocket scientist to figure out if you change the views of those people that are on the Federal Open Market Committee, and the monetary policy is going to change.
So this really is a pivotal time for central bank monetary policy, not just in terms of the fact that they've started pivoting, but the fact that we perhaps may have a regime change at the Fed itself in terms of what policy to pursue. And so
that gets a little bit back into your starting question. You had a bunch of these central banks we were going to go through, what they did and what I thought about it. So let's go through those. So yes. It's dynamic. Things are happening right now that people have to pay attention to. And one thing that's happening is that the economy, not only the U.S. economy, but the world economy, is slowing down. So that's one piece of background. Inflation has slowed down and is kind of stabilized now, the official rates. And now we're talking about changing the interest rate stance, not necessarily, which is one indicator of monetary policy, but not the key one. The key one is the money supply, which we'll talk about. So how should we start? You want to go through what? Which one?
Well, we don't have too much time, Professor, but I'd like to just go over the highlights of each of the central banks, starting with back home where I am in Canada. This is an interesting statement, sentence from their statement, from the Bank of Canada statement, rather. The federal government's recent decision to remove most retaliatory tariffs on imported goods from the U.S. will mean less upward pressure on the prices of these goods going forward. So they're directly citing the removal of retaliatory tariffs as one of the reasons for why they're lowering rates. I'm wondering why, or not why, but I'm wondering if we're in a period where trade policy. No,
I don't think it's a good reason. The retaliatory tariffs don't have much to do with the overall inflation rate. They have a lot to do with relative prices of different goods and services that are.
We don't know if the Bank of Canada believes in the money supply either. Maybe they don't believe.
But look at what they're doing. The Hanke's golden growth rate for Canada, consistent with hitting their inflation target, is a range of 1% to 3%. So my golden growth rate is 6.2% to 8.2%, and they're currently growing at 4.9%. So they have room to loosen up, actually, because what's happening? Their inflation is within the target zone of 1% to 3%. It's 1.7%. So actually, they're doing pretty well. Basically, their money supply is growing a little lower than the low end of Hanke's golden growth rate, 6.2. They're growing at 4.9. So I give them a pass, basically.
The Bank of Japan.
I don't give them a pass on the reason that they didn't do anything, but I give them a pass on what they're doing.
Well, maybe they're just following the Fed with no other major reason.
They probably are.
Yeah. Okay. Well, let's take a look at another central bank. So the Bank of Japan is one of the countries that did not cut rates. They left rates unchanged. This happened. However, the Japanese stock market sold off this week as the Bank of Japan unveiled plans to start selling as $250 billion cash of exchange-traded funds, an unwinding that the governor of the Bank of Japan, Ueda, said would take a century. Okay, interesting. First of all, why are they doing this? And also, does the U.S. have similar mechanisms for monetary policy? In other words, selling assets.
Yes. Well, the U.S. has plenty. Every central bank has a mechanism. They have assets on their balance sheet, and they can sell them if they want to. They can shrink their balance sheets. They could do literally quantitative tightening if they wanted to. That's what the U.S. is doing. It's letting the assets on the balance sheet run off, mature and run off.
We know they own a lot of treasuries and of different maturities. Do they own actual stocks and ETFs like the Bank of Japan does?
No.
Okay.
There might be some very small holdings, but not in general. Not equities. No. The Swiss National Bank owns a lot of equities, for example. The U.S. Fed does not at present. They have mortgage-backed securities and treasuries. Those are the big items on the balance sheet for the U.S. Fed. Now, the Bank of Japan. The problem is the Bank of Japan is just lost. They don't know what they're doing, and they haven't known what they're doing since about 1990. The money supply is growing only at 1% per year. Hanke's golden growth rate, a rate consistent with hitting the 2% inflation target, 6% a year. So they're just out of it, basically. So let's give them an F. We gave Canada a pass. Canada passed, and Japan flunked. Let's go to the next.
All right. I don't believe you've rated the Fed yet, but maybe we'll get to that later. The Bank of England also kept rates unchanged. I just want to read what they did, and then I'll ask my question. The Bank of England voted to keep rates unchanged on hold on Thursday as it weighs up sticky UK inflation with an uncertain growth outlook in jobs market. Okay, so the Monetary Policy Committee voted 7-2 to keep rates steady at 4%. Two members of the MPS in favor to reduce the separate benchmark bank rate by 25 basis points. The September decision to hold rates was widely expected. Professor, let me just say this. The first sentence, they voted to keep rates unchanged because of a sticky inflation situation with uncertain growth outlook. That sounds exactly like what's going on with the U.S. Powell even admitted that the growth outlook for the jobs market is relatively uncertain. I'm paraphrasing here. Except I'm presuming Starmer isn't pressuring the Bank of England to lower rates like Trump is. So maybe the Bank of England is doing what the Fed should be doing, except without political pressure. Maybe. I'll let you comment.
Well, they have a little bit of a problem because, in fact, they've lowered the growth rate considerably. Again, they're not looking at the money supply, unfortunately, with the Bank of England, but the growth rate is down at year over year 3.7%, and again, Hanke's golden growth rate, one consistent with the 2%, is about 5.7%. So the growth rate in the money supply is anemic, but their problem is, again, they haven't unwound all the inflation in the system. The inflation rate is 3.7%. Now that's almost double the inflation target. So they have a little bit of a dilemma. The problem with these things, they've gotten really out of whack because of the roller coaster. Everybody goosed the money supply when the pandemic hit in 2000, early 2000. Everybody got a lot of inflation as a result of that. Then they start contracting the money supply to pull down inflation. And that money supply contraction still in the picture. Things haven't, the roller coaster up and down, up and down, up and down. And what they need to have, David, is a steady growth in the money supply at roughly Hanke's golden growth rate. So they all these central banks are just off kilter now, and in the sense that they still are squeezing the money supply. And the reason they're squeezing the money supply is that the inflation rate hasn't really come down to their targets yet in all cases. So they have a problem.
All right, final question before we go. I think we've covered all the major central banks. Well, the ECB we didn't talk about, but we can skip that for today.
How about the ECB? They're
all right.
They have inflation really at the target at 2.1%. Their target is 2%. So they're at their target, and the money supply, to get at the target, they've squeezed the money supply down to a growth rate of 3.3% year over year, when it should be about 6% if it was in a steady state, hitting their inflation target of 2%.
Yeah, so, it's they kept rates unchanged.
So I think they have again the transition to normal running operation is underway at all these central banks. The only one we really have as a complete outlier is Japan.
How does that make sense that if the ECB's inflation rate is the closest to their 2% target, that they're the ones keeping rates unchanged? Shouldn't they be lowering rates?
Well, the reason for that is that they have squeezed actually more than anyone else. Excuse me, you're talking about the ECB?
Yeah, if the ECB's inflation rate, like you said, is the closest to target, why aren't they lowering rates? Isn't that counterintuitive?
No, because what the inflation rate today is based on what was going on with the money supply a year or two ago. What was going on with the money supply at the ECB a year ago? It was we were down at almost no growth in the money supply. Precisely in June of 2024, it had started increasing, but it was only 2.4%, the growth rate in the money supply. And 6% is the rate consistent with hitting the inflation target of 2%. So I'm not surprised the inflation has come down, because we had actually, if we go back to this if we go back to June of 2023,
Hmm.
it was only growing at 0.9%, the money supply year over year. So
Yeah.
that's why the inflation has come down. It's, again, this is a trick. The money supply is the key determinant of the inflation rate. But what money supply? It's the money supply changes that were going on a long time ago in the past. And they only feed through with a long and variable lag into today's inflation numbers. So that's why all of this is very tricky to even discuss.
Final question before I go. I know you're on a time limit today, Professor. What happens to the dollar now that we've got somewhat of a divergence of central bank policies around the world?
Dollar's going to keep weakening, and get into the key dollar price is the dollar euro rate, and I think the fair value is 120 to 140, and we're at about let's just look. It's around 117, 118. I haven't actually looked today. Today, as we speak, it is 1.175. Just about exactly where I thought it was. So it's still strong. It's on the strong end of things, David. It's stronger than 120, which
Yeah.
is my strong end for the fair value range of 120 to 140. So I think that the dollar will slip into the fair value range. It will go from 117 to weaken to 120 and further into that range.
I've heard
So
130 is the weakest number, but yeah, so people agree with you there.
no, 140.
Okay.
My fair value range for the dollar euro is 120 to 140.
I
It's
get
at
it.
117 now. Very, very strong, but weakening. It's been weakening now for what, 6 or 9 months.
Yes. All right. Well, thank you very much, Professor. We'll leave it here, and we'll catch up again in a couple of weeks. Where can we find you and read your work in the meantime?
You can follow me on X at Steve_Hanke. And the key takeaway is that the gold secular bull market will continue and probably peak out at around 6,000 an ounce.